Taher Badshah, Head Equities Mutual Fund, Motilal, Oswal AMC is now joining us. Taher, good morning. As far as markets are concerned, there just seems to be no correction. There was a 2-day correction, and now in the last 2-3 days, we've actually regained more than about 50% of the losses.
Yeah, I think, clearly things are in the right direction as far as the overall economy goes. So it's very hard to expect a significant correction in the markets. But we are, as we keep climbing up, we also get into a situation where clearly valuations, even on a forward basis, start looking, getting more and more challenging. And therefore earnings start lagging behind by some margin. So we have to, there will always be a requirement for earnings to catch up before markets can continue to trend higher like this. So I think overall the macro situation looks promising. Overall, we are continuing to probably follow the footprints of the global markets in the very near term, given that there are lack of triggers as far as the domestic market goes. So I think that's going to be the norm for the day. But as we rise higher, we all will get even more and more confronted with the challenge of having earnings to follow. And if that falls short of expectations or some such, then we could probably see a correction in the markets.
We saw a correction on last Friday and Monday because of what's happening with global markets. Some of the global bonds really yield spiking. Do you think the recovery that we are seeing now suggests that a lot of money is waiting on the sidelines? So the next 2 or 3 corrections may also be bought into, if there is any?
Yeah, the flow situation has been fairly robust, at least from the foreign investors' side, and that probably will, always bounce back as soon as we get indications that the Fed is going to hold back for a while, or even the other economies are going to hold any kind of interest rate hikes, or maybe continue with quantitative easing, in fact, on the other side. So I think a flow situation will dictate the course of the markets in the very short run, and we could see a good resumption of flows if, let's say, the coming week passes by without any disruption as far as interest rates go in the global system.
As far as Fed interest rates are concerned, is that really an overhyped event by the markets?
Well, I mean, the market, the interest rate levels in the US are such that there is clearly very low downside or very less amount of room for rates to head any lower. So obviously, any kind of directional move upwards will be taken with a little bit of skepticism, because it begins the trend of increasing interest rates in the US, and that obviously is implications for not just global interest rates and interest rates across emerging markets like India, but also has significant implications for flows and the currencies as well. So I don't think it is a overhyped event. It is an important event as such, but closer to the date of any kind of decision, we will always see volatility to be higher. So now we have to bear that volatility, and I think that is where we are in the throes of that volatility in the very short run. Hopefully, we will get over it post next week.
Last time around in 2009, 2010, we continuously saw selling pressure coming in from mutual funds, or redemptions were pretty high. Is that the difference this time? That markets have seen almost a big correction in Jan and Feb, but mutual fund flows never stopped. In fact, we have again started to see mutual fund flows pick up despite the sort of returns that we have given on a yearly basis. So that's the big difference.
Yeah, I think you're right, and as far as domestic mutual fund inflows go, I think quite a lot is influenced by the overall levels of the market, and also as far as the mid-sized companies and the mid-caps continue to do well, domestic money always gets attracted. Not just the flows into mutual funds, but even retail investors and other classes of investors actually start stepping in. So it's always hard to say whether it is the markets which are driving the flows or the flows which are driving the markets, at least as far as the domestics go in times like these when the rally is almost one way. So yes, I mean you are probably likely to see continued participation from investors if especially if the interest in the mid-cap companies continues to be the way it has been in the recent past.
I was just looking at the consensus mid-cap index and the growth over there. EPS estimate growth is greater than 30% versus Nifty of about 15 odd percent. Is that a fair estimate given that last 2 years earnings have been driven by the mid-cap space?
Well, the number for the forward year is looking a little difficult. I mean, it's always very hard to say as far as the mid-cap index earnings goes, because it's not a small bunch of companies. It is a set of 100 odd companies, and you could have a lot of variation. Some of them are probably not even very actively covered on the street, and therefore estimates can vary. And it's a very distributed index as well. It is not that it is very concentrated and just the top 50 companies determine the index, the earnings of the index as such. So to that extent, I think one is a little more in control of what the earnings expectations are for the large cap companies, or let's say the large cap indices like the Nifty or the BSE. Hard to call on the earnings expectations of mid-sized companies. It could vary dramatically from one company to another, depending upon the sector or the situation of that company in that particular industry. So you will see a lot of variations. You have to follow a very bottom-up approach as far as mid-caps go.
In your some of your
However, I
key
would
funds,
suffice to say that.
Go ahead, Taher.
I just wanted to conclude by saying that suffice to say that if you look at it from a trailing earnings perspective, then the mid-cap index is clearly looking reasonably ahead of the large cap index, and the valuation gap has substantially increased in the recent past. Even if you look at the last 1 year return versus the large cap indices, which have done about 15 odd percent, the mid cap index has done almost about 23-24%. So clearly the valuation gap is widening, and that's at some level not very comfortable. But from an index perspective, individual stocks could differ dramatically.
As far as Motilal Oswal AMC is concerned, how would you approach a new stock at the current index level, especially of the mid-cap and the small-cap space? You tend to look at a lot of mid-cap, small-cap names. How should an investor approach at the mid-cap names at this point of time?
So I don't think the current scenario or the timing or the situation of the market changes anything for us from a selection of a stock, be it large cap or mid cap, particularly even in the mid cap space. We are still driven by that same underlying philosophy that we want to buy into companies which we believe have decent business quality and of course management quality as well. We see good growth prospects from a medium term perspective, at least for the next 3-4 years, and are available at reasonable valuations. I mean, it's a very wide market. It has got a substantially high number of listed stocks, and plus we are seeing newer IPOs which are also throwing up some very interesting newer business models. So there is a wide canvas of opportunity. And even in this market, it is not very difficult to find companies which are reasonable, at least from the perspective of how you see it under the lens of the business and the growth agenda for the next few years. So I think that is our approach, and that is going to continue irrespective of. We found expensive companies even in very stagnant markets, and we found cheap companies even in very elevated markets. So I think it's all about scanning the environment, scanning for opportunities, and trying to assess as closely as possible the growth that one can throw up, that the companies can throw up.
Good morning, Mr. Badshah. This is Anindya from the Delhi studio. One is hearing the trailing P being mentioned after a very, very long time on Indian business television. And that's interesting for me because it kind of ties in with what of things that big investors like you, people who manage other people's money have been talking about. That look at companies which have a good past record. Have Indian investors started looking a little bit more to back rather than forward?
I'm not too sure. I mean, people are, the market is generally still focused on what the forward earnings are likely to be. But it is important to have a reality check in terms of where the current valuations are. And the only true valuation which is available today to any investor for that matter on the street is the trailing valuation, because that is a reality and that is the achieved earnings.
Yeah.
So you can't be too distanced from the trailing earnings unless you have very strong reasons to believe that the growth which you are anticipating for the future is going to turn out the way you are expecting, and markets will then reprice that growth. If that is your belief or your conviction, then I think that is what you have to take it forward, and place your bets accordingly. But I think from the point of view, you're absolutely right that for us at least the starting point is not just the trailing valuations, but the trailing performance of the business as well, as to what the companies have been able to achieve in the last 3, 4, 5 years, or maybe even more, and then take a call on what can be expected out of the future.
I'm going to be a little bit more stock specific with your permission, and I'm not going to ask you about things which are not in the public domain, but I'm going to pick up things which are in the Motilal Oswal mutual fund portfolio, because that is a house you represent, and even if you don't directly manage it, I guess you'll have a view on it in some way. I'm going to start off by asking about a company called Ajanta Pharma, and the reason is that because that's what I'm finding in your mutual fund portfolio. If I look at its forward earning multiple, it is clearly trading much more expensive than any other pharma company that you can find in the space, because it's trading at about 28 times FY18 consensus earnings. Your own estimates might be much higher. But if I go back and look at the CAGR growth, then sales growth has been at about 28, 29% 5-year CAGR, and earnings growth more than 50%. If I'm wrong, correct me. And therefore, it's the backward-looking thing which still makes it a buying opportunity. Whereas if I look at forward earnings and look at the multiple looks very expensive.
Yes, so you're right that the growth rate of the previous 5 or 7 years has been very strong, and it was also a certain at a certain level it was a base effect as well, because the company was relatively smaller at that point. It's small today as well. But obviously those rates are not sustainable in terms of growth. But there is also a transition which is happening in the business from a forward-looking perspective, that the US business is now starting to come to the cusp of delivering. They have till now been a very domestically oriented company, and the US presence has been very limited. They've now got a few approvals which are reasonably promising, and they've been off to a good start as far as the US opportunity goes. And the opportunities are such that even for them even a small approval or small market could mean a big delta to their earnings. And that probably makes the forward-looking earnings a little more attractive.
Right. So therefore, the argument that I was making, the argument that you're making, what I understand is that you do have to look at past earnings, and even if you think that growth is going to continue, even if it's slowed down a little bit, you're willing to pay a higher valuation or a higher multiple, a relative valuation for a company. Is that fair argument to make?
So, I can only tell you that this has been a company which has been in our portfolio for since inception, and we have sat through it, and we've also had a couple of quarters when it has not done anything.
All right.
And perhaps growth has also slowed down in a bit, but we have stayed through the course.
Okay. I'm looking at some other companies, for instance. Let's look at what you're focusing on. Again, I'm going by what is in the public domain. And there's, in your portfolio, there's Britannia and there's Manpasand Beverages. That is direct, the last point of FMCG, if one can say, things that you directly eat, biscuits and mango sip and things that you do. You seem to be focusing on the last point of consumption.
Yeah, we've, as far as our consumption or staples or, FMCG related exposure goes, we've been very, very selective. So if you look at the portfolio, you mentioned a couple of these companies. There are not too many companies of that in that basket. So we've been very focused in terms of picking up sectors, companies within a sector which are, again, where we see the footprint of growth being better than the rest of the industry, and perhaps a little better than the market as well. In general. So I think, again, in case of Britannia, we've seen a similar thing, very strong delivery of the last few years. And we think, it is now very well positioned as far as its approach to the segment goes. Earlier, it was in a segment, it's in a segment right now which was considered premium at one point in time. But now it is bang on the middle of the market segment. So I think, and he has got superiority out there. So I think we see good amount of growth potential going forward. And there are certain operating efficiencies, etc., which are also yet to kick in. So I think that's how we have gone about selecting some of these companies, that where we see quality, we see continuity of growth, and we see the opportunity canvas being reasonably large from a longer term perspective.
When one goes into various mutual fund portfolios, and we obviously look at the ones for analysis, the ones which are performing well, one finds a lot of supplier companies, OEMs, ball bearing manufacturers, adhesive manufacturers. But when I look at yours, then the supply that you're looking at is essential financial supplies. Huge overweight on financials, right?
Right.
So if you could just give us the investment logic there.
Well, I think, again, we've never approached it from a sector perspective that we wanted to be 40% in NBFCs. These are, again, very bottom-up, hand-picked ideas. And they just happen to be called as NBFCs. But if you look at it a little more closely, then all of them are, different in their own way. So one is a consumer finance company, one is a ratings business, the other is a microfinance business, the other is, insurance business. Nothing to do with each other in a way at one level.
Right.
Of course, market might color them in the same brush, but, they are not the same in terms of business models. So I think we have a good amount of diversity, even despite the fact that the nomenclature-wise, they all are called NBFCs.
But it's essentially financials. I know that you're saying that there, and if I look at it, there is, at least in two of the portfolios, a completely money market play with significant weight. CBLO and reverse repo investments, right?
No, that must be the cash component that you're referring to.
That's the cash component, which is
that is temporary surpluses.
Okay, so that seems to be right up there. So the cash holding right now appears to be slightly high, Mr. Badshah?
No, I don't think so. I'm not too sure which number you're referring to, but it would not be, at best, not more than a couple of percentage points. And that too probably might be because we're transitioning from one stock to another.
Okay, I'm just looking at something like Motilal Oswal most focused long-term fund, right? That right now has a CBLO's reverse repo investment of 6% of your total holdings. If that is cash, then that's quite a high amount, right?
Yeah, so that's again not with the intention of holding any cash or taking any market call or cash call. It's essentially, like as I said, transitioning from one to another in the portfolio. And you could see temporary cash at the end of the month.
Because a lot of funds which are close-ended and which can actually hedge their position seem to be saying that they are currently more on cash than historically that they have been, or more on cash than they have been in the past few months. But you are not doing that, right, in Motilal Oswal?
No, not at all. I mean, this is typically, this is atypical of this cash level being at this. If you rewind in the past, you will not find it to be as high.
All right.
And this has nothing to do with any call in the market.
Okay. I guess that's the most important thing that our viewers need to know. If they go to your portfolio and look at this and think that it's cash, then it's not a call on the market. So the call on the market is essentially positive. You think that even from these levels, we should continue to go higher. But I know you mentioned that don't look at the Nifty and Sensex.
Yeah, no, I said, like I'm saying, the backdrop is of a confident mood from an economic perspective, as well as from overall flows and overall mood of the market. But we have to be selective. I mean, ours is not driven as much by levels of the market alone. We are entirely bottom-up driven. You know how our portfolios are constructed. So it's an entirely bottom-up driven approach, and be it at whatever level of the market, we kind of don't distance ourselves from the core that we have set ourselves, and we keep doing stock selection or business selection exactly on those lines. So I think in the backdrop of a decent market, you keep evaluating different opportunities at different times.
So how do the fund managers or the people who manage portfolio go about? When you say that it's bottom up, there has to be a starting point. Is it a thematic starting point? Is it just a completely financial starting point? How do you work it out?
So yeah, we look at, like as I said, past delivery is important, and that gives a very good understanding of what is the business like. And, because many businesses in India don't end up making enough return on cost of capital compared to cost of capital. And if you see businesses which are have been able to do that sustainably over a 3-year, 5-year, 7-year, maybe even more a longer period of time, then you know that there are certain competencies which the business has, which is allowing them to earn decent returns above cost of capital. So if that being the case, then it becomes a good starting point for investigation as to what is driving the business, what is the uniqueness of the business model, and if there are certain unique parameters, then that is something which excites us most. So we try to, in our portfolio, if you look at most of our companies, they have some unique advantage or the other. One either could be market share, it could be leadership quality, it could be technology, it could be a monopolistic business situation, or it could be brands, distribution. So something which gives the company an edge over most of its competitors. Could be market share. So those kind of things. So that's a good reasonable starting point, because from then onwards you know that you're getting into better business quality. And then you try to evaluate what it takes to run the business, economics of it, and the whole lot of things associated with it. And at the next level, get to the examining of the growth, as to what kind of growth then these companies achieve. Because you don't also want to, we are not significantly biased towards value plays where there is insufficient growth. So we don't really want to fall into that trap either. So we generally stay away from companies where we can't see any growth. I mean, there could be companies which are probably not seeing some growth right now, but we are pretty sure that whenever the growth comes back into those segments, then they will be the biggest beneficiaries of that growth. So you have to have that conviction one way or the other. So, but we don't really want to get into severe value traps. And I think if we can maintain that balance, then we are good. And lastly, it is the valuations that you probably have decent valuations. We not insist on single-digit P multiples. If we're getting good quality and decent growth, we know that we may have to pay a little higher, and we are good with it, because we make our investment horizons reasonably long, so as to be able to take some part of the slightly extended valuation, if at all, because that over a period of time will correct itself, and you'll be able to at least have the comfort of being with good quality, good businesses.
Is it also that you try and pick up things which are going to withstand business cycles, or at least be not affected that much by business cycles? I'm taking the example of Supreme Industries, for instance. Whatever happens, I think in India more and more people will buy plastic chairs, they'll change their pipes. Is this something that you look at as well?
Yes, so we clearly avoid very heavy or deep cyclicals. Yeah. We may have been in a few shallow cyclicals, but again, they have to be businesses which are, as you rightly said, able to withstand difficult times, and be able to make a return on capital which is ahead of the market even during some very difficult times. So if that is the case, and if they can make 15, 18, 20% ROCEs even in downturns and sharp downturns, I think we don't mind if other parts of the franchise, if other parameters of the franchise are reasonably strong. But our weightage in some of these names would be relatively on the lower side, and they would not figure among our top picks anyways.
Okay, before I let you go, Mr. Badshah, I have one question. You did mention that these are, let's take something like Interglobe Aviation, and I have specifically about that. Is that, did you get into it as soon as it was in the IPO, or is that a thematic play based on low crude prices? What is that?
Yeah, we've kind of, we didn't participate in the IPO, but we've been early into the buying after its listing. So I think that's been a stock for us for the last nearly a year since it has been listed now. So I think, yeah, again, the stock selection is all based on our framework, and so long as it fits into our QGLP, quality, growth, longevity, price framework, I think we are okay. And we felt at the time when we bought it that unlike any other of our holdings, that it fits our QGLP parameters. And yes, it's we are still amongst our important holdings even today.
How difficult do you find it to sell, even when it something to you looks, you become uncomfortable about valuations? Is it something you find? Is there a difficulty in selling?
Not really. I mean, we've always found that if you've ensured decent amount of quality in your portfolio, then you get enough time to evaluate, and you don't. And as far as you don't panic, and you're not selling in distress, one is reasonably fine with the liquidity on most of our names, be it large caps or even mid caps for that matter. So we've never encountered a challenge where we've had significant difficulty in getting out of some of the names.
Let me rephrase that question. I think
I
I had asked that question wrongly. What I meant is that psychologically, how difficult does it become? Because there's a sense of ownership one finds. In television we say, kill your lovelies. When you write a story, shoot a story, you get involved with certain shots, but you have to shorten it, so you have to sometimes kill it. What happens when something becomes uncomfortable in terms of valuations? How hard do you find it psychologically to sell it at that time?
So, it may, at that time, it may not necessarily be a situation of an outright sell. So, like as I said, we don't buy based on only valuations, that if valuations are cheap, then we buy, and valuations are expensive, it's a case for sell. If things go really out of hand and valuations become outrageous, then we would probably significantly scale down the exposure to the portfolio. That is the first action. Not as much of exiting the stock entirely. The exit of a stock is largely driven by fundamentals. So if you think your fundamental assumptions have completely gone wrong, and what you had expected out of the business or the company is not turning out the way it was at all, then that's a clear case for sell. At that time, we don't see whether it is trading at 52-week lows or 52-week highs.
All right, Taher Badshah, thank you so much for joining us.